This video is sponsored by Skillshare. The first 1,000 people to click the link in the description below will get a free trial of Skillshare's premium membership. Options have become one of the most popular investment vehicles for retail traders over the past decade. They make it easy to long or short positions, can be used to generate income in a portfolio, and provide leveraged returns, meaning that you're more likely to either make it big or lose it all. That's the thing about options. As popular as they are, and as much as traders love them, they are still a higher risk security and can quickly cost you more than a few percentage points. For most amateur and long-term investors, they aren't really that appropriate. But for those who do decide to deal in the space, many look to manage their risks, and to help do so, many will turn to the guidance of the Greeks. And no, I'm not talking about the great philosophers of old, but rather these guys: Delta, Gamma, Theta, Vega, and Rho. The Greeks are a set of metrics that measure how different factors influence an option's value. And by going through each one, we can better understand the risks faced by options traders and how they can be better managed. So let's go through our Greek ABCs, or alpha, beta, gammas, on today's Plain Bagel. In the world of investments, Greek letters are a fan favorite for describing a number of different things. Alpha is used to represent excess return achieved by active investors, while beta describes the market return, or more accurately in some models, how a position moves relative to the market. But when it comes to options, there are 5 specific Greek letters that investors tend to focus on: Delta, Gamma, Theta, Vega, and Rho. Now, these aren't the only variables that can be analyzed with options, and they aren't even the only Greek letters, but they are the most pertinent. And by better understanding how they influence an option's return, we can better understand what exactly causes an option to go up or down in value. I know it may seem like a simple thing, but it's actually a bit more complicated than you might expect. So it's worth diving into. But before I get into that, I do want to make a quick note that there will be a link in the description below for a video that further explains options in case you need a review of the basics. But for a quick refresher, options come in 2 main forms: call options, which give you the ability to buy a stock in the future, and put options, which provide the right to sell, both at a predetermined price. And the price tag for this right, if you will, is known as the premium, basically how much the option is worth. If you buy or go long these options, then you'll pay the premium to the option writer, or the seller. And if you sell or short the option, then you'll be paid the premium and will profit if the option goes unused. Alright, so with that out of the way, let's meet our Greeks. Each of the Greek variables measures how an option's value, aka its premium or price, is impacted by a certain factor. And our first Greek, delta, is the most fundamental of the lot, measuring the relationship between an option's price and that of the underlying stock. It's often the variable that you'll see tossed around on online forums if you follow investment forums online. Delta shows how much an option's value will change for every $1 increase in the stock it represents. If an option has a delta of 0.2, it'll increase in price by 20 cents when the underlying stock goes up by $1. Delta will be between 0 and +1 for call options, since call options become more valuable the higher the stock price rises, and it will be between -1 and 0 for put options, since these options lose value the higher the stock price rises. Now, delta is also higher for more in the money or profitable positions, and it will be lower for more out of the money or unprofitable options, which is why many actually use delta as a rough gauge of the probability an option will end up being profitable. The higher the number, the more attractive the option, and the more likely, theoretically, that you'll make money. You can probably see why a lot of traders like to pay particular attention to delta. But as helpful as it can be, there is a challenge with the figure. Every time a stock's price, and as a result our option price, changes, so too does our options delta. You can see how that complicates things a little bit. But because of this, many traders will look to consult our second Greek, gamma, which interestingly measures the sensitivity of delta to changes in the underlying stock price. Now, I know that's a level of inception some may find confusing, but the math isn't actually all that bad here. Simply put, gamma shows how much delta will change if the underlying stock goes up by $1. As an example, imagine we have a $2 option with a delta of 0.2 and a gamma of 0.1. If the underlying stock goes up by $1, then our delta dictates that our option will go up by 20 cents to $2.20. Meanwhile, delta will go up by 0.1, the value of gamma, to 0.3. That means that the next time the stock goes up by $1, our option will increase 30 cents instead. Gamma is typically higher for options that are at the money or around their break even, while being lower for stocks that are deep in or out of the money. And yes, it too does change with the underlying stock price, but we won't dive any deeper into that because we have to move on to our next Greek, the most despised of the lot, depending on who you are. Theta, also known as time decay, represents how much time impacts an option's value. Given that options are a temporary investment with a literal expiration date, every passing day actually deteriorates their value. For buyers, theta is a negative, as they'll have less time to turn a profit with their position, while option sellers actually have a positive theta, since they will benefit if the option ends up going unused. If an option has a theta of negative 0.2, it will fall in value by 20 cents every passing day. Now, similar to gamma, theta will be higher for options that are at the money compared to those that are deep in or out of the money, more or less because the fate of the option has yet to be decided and could still go either way, meaning time will play a more important role in determining how much money is made or lost with the position. Now, in the same way that time translates into more opportunities for a trader to make money with an option, volatility, or how much the underlying stock's price swings around, is likewise a valuable asset as it increases the likelihood a stock will reach the option's strike price. To illustrate this, imagine a trader deciding between two options with the same strike price. One is for a volatile stock, and the other is for a relatively stable position. If both stocks start off at the same price, which option do you think is more likely to be profitable? Well, all else held constant, the more volatile position is more likely to hit the strike price before the options expire. So while it might sound like blasphemy to a more longer-term conservative investor, the trader would actually be better off going for the more unstable option of the two. This is why our fourth Greek, Vega for volatility, actually increases the value of our options. The metric measures how much an option's price will change for every percentage point increase in the underlying stock's implied volatility. Now, implied volatility is a bit different and more complicated than historical volatility, which can be calculated pretty easily using historical prices. Implied volatility is actually an estimate that captures the market's view of the likelihood a security's price will change, so it's a forward-looking metric. IV, as it's sometimes called, can be estimated through a number of different models, which we unfortunately don't have time to cover. But it's worth noting that's generally higher for stocks with higher demand and during bear markets, when stocks are assumed to be more volatile. Zooming back out to Vega, which again shows how an options price reacts to changes in the underlying stock's implied volatility, the metric tends to be higher for options that are at the money and have a longer term to maturity. Finally, there is Rho, the runt of the group that is less popular of the Greeks to analyze, but it's an important one to understand nonetheless. Rho measures how an option is influenced by changing interest rates, specifically the US Treasury bill rate in the US. It is positive for call options, meaning that call options become more valuable as rates rise, and it will be negative for put options. Similar to Vega, Rho is higher for options that are at the money and have a longer term to maturity. However, it does tend to have a very minor impact on option prices, and since rates often move very slowly and in small increments, at least in the US, it's a less influential variable. But those are the Greeks, the variables used to assess risk in the world of options. Now, you may have noticed that we didn't actually cover how to calculate any of these numbers, and indeed you can do some of these calculations manually, but they are typically readily available on trading platforms who will calculate them automatically for you. And given how quickly markets move and how numbers might change by the time you finish the calculation, relying on those automatic figures is usually a more viable option. No pun intended. But even with a full set of calculated and up-to-date Greek variables at the ready, I do want to highlight that as neat as these tools are, they are still technically theoretical. And option prices might not move according to the exact figures you've calculated. And in fact, something unexpected might occur that isn't accounted for by these variables, which is honestly the case for most models in the world of investing. But that being said, the Greeks are still helpful in gauging the risk that you face when dealing with options and in better understanding how they work. Now, as always, I want to reiterate that options require much more experience and education than standard investments. Unless you are interested in watching your positions on the daily and dealing with those added risks, you don't need to deal in them. But if you do decide to work with options, at least you'll have one more tool in your belt to help out. Just tread carefully. The Greeks can provide guidance, but they are no oracle. And you don't want to risk accidentally flying too close to the sun when dealing with this special investment. This video is sponsored by Skillshare. If you're someone like me who's always looking to try something new, or you're just interested in honing a skill you already have, Skillshare is a great service that you might find handy. They're a learning platform that hosts classes on thousands of different topics, and I've used them a lot personally for the channel and video editing. Advanced video editing with Adobe Premiere Pro 2020 by Jordi Vandeput was one Skillshare class that really helped me with my videos. It provided a lot of tips and information around things like masking and keyframes that I just didn't know beforehand. But if you're instead into cooking, painting, drawing, writing, or really anything else, they have classes on other subjects you'll likely be interested in, and they're always adding new ones to their library. And if English isn't your first language, no sweat. Skillshare now has subtitles in Spanish, French, Portuguese, and Dutch, so the classes are pretty accessible. So if you'd like to try out Skillshare, the first 1,000 people to click the link in the description below will get a 1-month free trial, which will give you unlimited access to their whole library. That's a lot of access. So check them out and try pottery, or interior design, or anything, whatever you want to do. I'm sure you'll find it on the platform.